Good morning. My name is Danielle Kosick, and I'm here today with my dad.
Good morning.
With heightened market volatility and economic uncertainty, we're providing frequent, relevant updates, either by video or email, to make sure you are staying informed as it pertains to the management of your investment portfolio. So today, Dad, I have a few questions for you.
Very good.
Could you remind us what 3 criteria you use to evaluate any buy, sell, or hold recommendations within our clients' portfolios?
Sure. We specifically use 3 criteria to evaluate any recommendations that we make. The first is valuations. We seek to answer this question first and foremost. How do current price metrics compare with historical data points that would suggest valuations are currently cheap, expensive, or fairly valued? Second, economic conditions. We answer the question, where is currency exchange rates? Where is crude trading? Where is a country leaning politically? And the third is momentum. Without any momentum, the first 2 are meaningless. If your idea turns out to be right, but you act too quickly, you may have to experience years of underperformance until the tide turns, rotates. How this plays out in real life is that this is a combination of both science and art. Luckily, it's a lot more science.
Okay, that makes sense. Now, with that being said, I've heard a lot about stocks becoming cheap now, following the stock market dropping earlier in the year. Does the data support this view?
Actually, with the run-up in stocks that took place in 2019, much of the recent drop in stocks did no more than erase the overvalued position that stocks began this year with. Today, I'd share my belief is that the market is fairly valued, and that's only because bond yields are as low as they are. As an example, the chart shown here compares PE valuations as of December 2019 with PEs as of March 31st, 2020. It then further compares these 2 data points with the high and low extremes from the past 20 years. In almost all of the asset classes represented here, valuations are nowhere near what I would call cheap. Many of these would fall into a more middle-of-the-road, fairly valued position based upon this data.
Lastly, does anyone have an advantage over others as to knowing what is going to happen for sure in the market?
Obviously, none of us have a crystal ball. I wish I knew what no one else knew, but I'm no better than Warren Buffett or anybody else. I watched Warren on CNBC on February 24th, the first day that the market started to drop. And what Warren said is, if you have cash, you should buy stocks. Not real good timing, Warren. What Warren said in 2008, which is prophetic and executable, was, when everyone else is greedy, be fearful. When everyone else is fearful, be greedy. What we can do is use current valuation data to not overpay for the hype. Over the next decade, we'll expect very mixed results, with certain asset classes lagging historical performance averages, while other pockets of the markets could outperform historical averages based upon where they are today. This is actually what has happened over the past 10 years. During that period, the US S&P 500 index has gone up 101%. The US Value 2000 index, an index for small US companies, did only 19%. An emerging markets index, the index for developing countries, actually is negative at 14%. Eventually, a stock category which is deeply discounted will start to provide strong returns, but again, eventually. It would be nice if the numbers told us exactly where to be and when, but there are many unknown future triggers that will affect the timing of trends, shifts. This, therefore, requires us to manage allocation targets continually.
Thank you for watching today. From all of us here at DLAK Wealth Advisors, we hope that you and your family remain safe and healthy.